Good morning, everyone, and welcome to our DATIQ weekly market update. This is our update for February 27th, 2024. I'm Ken Animo, Chief of Analytics over here at DAT, joined by Dean Croak, who's our Principal Industry Analyst, and very special guest, returning guest, Sarita Willingham. Good morning.
Good morning.
Good morning.
Yeah.
It's been a while since we've had you on. It's been like over a year and a half, I think.
I think it was last year during the summertime, maybe. So
Okay.
definitely
Now I'm thinking warm thoughts, because we were talking before the show. It's warm and thunderstorming in Ohio. Maybe I'm bringing myself back to a time when it was warm. Sarita, do you mind giving everyone who might not be familiar with your background or what you're up to a brief intro?
Sure. Hi, everyone. Thanks for having me again. My name is Sarita Willingham. I'm the founder and CEO of SJW Logistics. We are a full-service 3PL offering freight transportation, warehousing, and order fulfillment services. And we're located here in the Lithia Springs, Georgia area.
Awesome. Well, thanks for joining us this morning. As we always do, when we have a great guest, we will get through our market update and forecast, and then bring you back for our discussion and question of the week. Does that sound good?
Yes.
All right. So we are sort of in those doldrums of February at the moment. I think we can pretty confidently say that the weather-related extension of peak we saw in January feels like quite a long time ago at this point. Even though it was only a few weeks in the rear view. So dry van spot rates drop below 2015 as the load to truck ratio approaches 2020 pandemic lows. We have active contract rates down 1.1%, replacement rates down 7.3%. That's good to see that those things are slowing down. That seems to indicate that as those bottom out and start to climb back up, the market will turn back upwards. The American Trucking Association's truckload tonnage index dropped 3.5% month over month and is down about 5% year over year, with the Jan cold weather being a factor. Produce season's off to a slow start following those heavy rains. An atmospheric river, I learn a new weather term every year. In California, national truckload volumes down 25% year over year, big number. California volumes down 84% year over year. And that accounted for 35% of truckload volumes February last year, just 8% of the total this year. So with that, I'll turn it over to Dean to help make sense of it all. Dean?
Yeah, thanks, Ken. We'll whip through the market update pretty quickly today. The long form version will be published this evening with all of the rates and charts and commentary. So let's start with load to truck ratio and dry van. Volumes down for the fifth week, down 15% last week. Some of the lowest load post volumes we've seen for this time in February in many years. Load to truck ratio was down about 12% last week to 1.02, so hovering around that one load per truck mark. The low we saw during the pandemic was 0.84, so we'll see how close we get to that next week. In the refrigerated market, very similar trend, 5-week decrease in volumes. Produce volumes are down about 25% year over year nationally, but as Ken mentioned, the California situation with the heavy rains is dragging down spot market volumes nationally. Load to truck ratio down to 1.63. The lowest it got during the pandemic was 1.35, so we're sitting above that by a little bit right now. And in flatbed, volumes are trending very closely with levels seen at the start of the pandemic. They're about half what they were last year. Load to truck ratio down about 5% to 6.76. This week, we're going to have a look at some Southeast markets to tie into Sarita's guest appearance this week. So we're starting off in the Southeast in dry van. Capacity was fairly tight across the region last week, the entire Southeast region. Well, tightened slightly. Rates are up a penny per mile, averaging $1.51. The regional average is sitting about a penny per mile above where it was in 2020 and about 3 cents a mile lower than what it was in 2019. One of the bigger markets we watch in the spot market is Atlanta. Loads moved, volumes are about 1% higher than last year. However, there's a lot of excess truckload capacity. Line haul rates were down slightly last week, averaging $1.53 for outbound loads. One of the lanes we watch very, very closely, one of the high volume lanes, is Atlanta to Lakeland. The volume of loads moving on that lane are about 11% higher than last year, but line haul rates are about 3% lower, averaging $2.40 a mile. Loads from Miami back to Atlanta are about 55% higher, but line haul rates are about 10% lower. So there's a lot of imbalance in the market right now, and rates are certainly very, very low on some of those lanes due to the excess capacity. In refrigerated, looking at some USDA produce volumes outbound in Florida, they've been flat for the last couple of weeks, about 31% lower than last year, which is coincidentally about the same time that the Plant City Strawberry Festival starts this week. Normally we see volumes a lot higher this time of the year. Between now and Mother's Day, produce volumes typically double outbound from Florida, but with major crops like tomatoes and strawberries down 18% and 38% year over year, there's an excess of reefer capacity at the moment, resulting in line haul rates dropping 14 cents a mile last week to $1.37. Remember, folks, these are line haul rates excluding fuel. And in flatbed, outbound Georgia flatbed rates were flat last week, but identical to this time in 2019, but about 14 cents a mile lower than last year. Line haul rates dropped by 2 cents a mile, averaging $2.12 in the Atlanta flatbed market, one of the largest in the region. They'd been increasing for the last 3 weeks, though, and even though the volume of outbound loads had increased 4%, rates were falling last week. And having a look at our year-over-year look at spot rates to wrap up the market report, dry van line haul rates dipped below 2015 last week, currently about 5 cents a mile lower than 2019, down 4 cents a mile last week, averaging $1.59. That's line haul rates excluding fuel, and that's about 15 cents a mile lower than last year. And our top 50 lanes, based on the volume of loads moved, averaged $1.84 last week. That's about 25 cents a mile higher than the national average. And in the refrigerated market, rates dropped for the 5th week, down 6 cents a mile last week, averaging $1.89. They've dropped about 20 cents a mile in the last 4 weeks, and 15 cents a mile lower than this time last year. And lastly, in flatbed, rates decreased for the 4th week, following last week's penny per mile decline. Average national rate is about $1.96 per mile. That's 16 cents a mile lower than last year, and it's sitting about 8 cents a mile higher than in 2020. So that's it for the market update. Remember, go to dat.com/market update this evening and download our weekly report. Back to you, Ken, for the short-term forecast.
Thank you, Dean. So we're seeing much more alignment on the forecast now than we have the previous few weeks. I'll come back in a few minutes to why that might not be a great thing. So these charts, we always start with dry van. The blue line is the historical data. It goes back a few months, in this case, to the beginning of August. It's a 7-day weighted moving average, and it excludes fuel. And then we have 4 forecast models. We have green, which is RateCast. Here's our longer term model. It's the flagship in all of our products. We have a red line, which is a very short term model. It tends to over exaggerate near term data. And I think it's really helpful to see. It's kind of like if you were to extend the current couple weeks trend forward, what it would look like. And you have gray and yellow, which are effectively blends of the two, in the sense that they straddle long and short term. And what you can see here is a pretty pronounced down into the right trend. I don't necessarily think that's going to be something we really experience, if that makes any sense. We should start to see by the end of this forecast horizon, which is late March, some upward trend in this data. You're seeing some optimism with inbound port freight flows and other things, which would indicate this turning around a bit. Let's go to reefer real quick. As you can see here, RateCast, which tends to contemplate more of the long term and seasonality, isn't nearly as pessimistic as the other forecasts. It has a little bit more backsliding before leveling off. And if we were to extend this forward with the longer term forecast, you would start to see that upward climb that you typically see in the spring with refrigerated. Lastly, for some optimism and some alignment, we have flatbed. This is a very much up into the right trend. As things start to thaw out potentially early, you're going to see building activity and other general flatbed activity pick up. So I think of the 3 forecasts, this one's definitely the most optimistic as we head over the next 35 days. With that, we'll come back with our question of the week.
Yeah, thanks, Ken. So, Saritha, Atlanta is regarded as one of the largest distribution freight markets in the Southeast. So let's start off our discussion. How is that market shaping up this year, as far as you can see?
As far as I can see from my perspective, being a small transportation company, it I don't see like a difference so far from last year. The freight that's available to me looks about the same. It's still over capacity. There the loads are, before we used to see consistent freight. They're consistent lanes. Now I'm seeing more like you may get a lane coming out of this market, but it may only be 1 day a week or 3 days a week because shipping is down as well. So it's not quite as consistent as I've seen it in the past.
Right. Are there any particular lanes? Before we got on air, we were talking about the northeast. Are there any particular lanes that are become more problematic in terms of lower volumes?
Um, the lanes, not really. I would say probably we used to run from Atlanta to Texas pretty consistently, or Georgia to Texas pretty consistently. Now it's kind of tough to get a lane going to Texas, especially at Dallas Houston area at a decent rate. The rate is much lower than it has been in the past. It's almost like coming out of Florida to go to Texas from Georgia.
Yeah. Most of your work is dry van, or do you get involved in refrigerated also?
Most of our work is dry van, flatbed, and drayage.
Right.
So we do a mix of those, not really refrigerated.
Got it. On the logistics side, I know you're involved in the warehousing logistics side of the business. The Atlanta's industrial market had some record levels of expansion last year. CBRE reported that the market expanded by 36 million square feet last year, some record-breaking construction completions. But one of the questions we've been pondering is, at what point do you get to an excess of warehouse capacity in the market? Are you still seeing new warehouses being, capacity being absorbed, or is there a sense that maybe we've got enough capacity or an excess of capacity in the warehouse space?
I think my personal opinion is that we have enough capacity in the warehouse space. I had contracts with companies for excess warehouse space needed for their overflow that are ending their contracts early because now their warehouses are coming open. And I've talked with my landlord because I've seen buildings just popping open around me. These buildings are starting to sit on the market now. Before you couldn't see it. We're talking about 20 and 30 and 80,000 square feet buildings, and mine is 22,000 square feet. So I'm not seeing a demand for 3PL capacity. We have a team doing cold calls and marketing, trying to find cross docking work and warehousing needs. And it's very few people that are needing that right now, that because they can do it in-house.
Yeah, that's interesting. I was out in Salt Lake City last week, and I always go for a drive around that airport area because in the last few years there's just been a massive expansion westward from the city out alongside the Salt Lake towards the big copper mine there. And I was noticing the same thing, that there were a lot of warehouses sitting empty that had recently been built in the last couple of years.
Mm-hmm.
That's an interesting trend. On the drayage side, what sort of trends are you seeing there? Because I imagine you're connected fairly closely with Savannah, correct?
Yes. I'm seeing, the capacity is down low that's needed. Ships are coming in. I think what's helping us keep a consistent lane that we have is that we have a dedicated customer that has consistent business year round. So we got lucky to find customers with consistent business. But as far as before, during the pandemic, you could go on the load boards and find a load. If you didn't have a load for that driver for the day, or a container for that driver for the day, it's not as easy to find a container. The rates have dropped. They're almost close to pre-pandemic rates that they want to move containers for, going from Savannah to Atlanta area, which is very popular lane. So we're seeing definitely an adjustment there, and we've had to make an adjustment. Our customers have asked for a decrease in the rates as well.
There was some news last week, and I was out of the country when I read it, so I can't quite remember, but there's a big infrastructure development going on in Savannah to help the drayage market. Have you caught up on that news? They're building some sort of highway to speed up the flow of trucks.
I have not, but I recently went to Savannah to visit the port for RFP they were putting out, and there is a lot of construction going around the port there with the congestion and everything, but it's nowhere near as, because of the low volume of containers coming in, it's nowhere near as congested as it was during the pandemic.
Right. Have you seen volume drop because of the rail line that's been built? And I think it goes all the way up into northern Georgia, southern Tennessee, if my memory serves me correctly.
Yes. Well, I have seen more volume coming into the rail line. My warehouse is 3 miles away from Norfolk Southern Rail Yard. And I have seen more emails and more people, even some of the freight forwarders that we work with, they are telling me that it's actually cheaper now if they put the container on the rail line and send it to the Atlanta or North Georgia and pick it up from there, because it's closer to delivery. So it's a little cheaper to do that than to have a trucker truck it from Savannah to Atlanta. So yes, I have seen an increase in needs on that side.
So just to be clear, they rail it to North Georgia and then dray it back to the Atlanta market, back south?
Yes, they'll rail it there, or they'll bring it straight into the Atlanta market.
Mm. Wow.
And they've gotten more strategic and smarter, right, with technology. So most of the stuff that goes to North Georgia is delivered in that North Georgia area. Most of the stuff that comes to Atlanta is delivered in the Atlanta area. So they've definitely gotten smarter with technology and making sure containers go as close to their destination as possible to cut down on the trucking rates.
Wow. On the asset side of the business, what sort of things are your drivers telling you about what's going on the highways, like as far as maybe infrastructure, traffic, weather, anything different that you're hearing this year that you didn't hear last year?
Well, not really. We are stretching our drivers out more when it makes sense, because some weeks, you get better pay for the miles, and some weeks we're letting them do less miles because the pay is better to go shorter miles. So they understand that. We explain things to our drivers. We try to watch, the weather locations, because this is that time of year where, you got ice storms and blizzards and different things going on with that. And we try to watch, the chain requirements, all kind of the DOT regulations. So our drivers are not really saying much, being honest. They're the ones that we have now. We have a pretty good team. They're really happy to be working and getting a consistent check there with everything that, the ups and downs we went through over the last year and a half.
Have you noticed a change in the number of applications you're getting, which is kind of a proxy for how many drivers are looking for work these days?
Yes, we have seen an increase in the number of applications we're getting. Seems like last year a lot of owner-operators were parking their trucks, going back as company drivers, but to the bigger companies, they were looking for benefits and all other things. Now we're getting an increase there for drivers that want to be 1099 and want to work for a smaller company.
That's interesting. So a lot of these owner-operators that were, when you say parking their trucks, do you think that was temporary, or do you get a sense that it's changed to being more permanent and they're getting out of that, sort of revoking their authority completely?
I think it's more permanent.
Yeah.
Because a lot of them bought trucks when the market was high and the trucks were severely overpriced, as I say. So even when they park their trucks, they still owe probably more than what the truck is worth at that point, but they can't afford the maintenance because maintenance is still high, different things like that. But at the end of the day, trying to continue to pay that in a market that has tight capacity and the rates are lower than what they need to be able to support their family and maintain their maintenance on their trucks, I think they'll stay in it a little bit longer, because right now it's kind of like I need to survive and be able to, support my family and put food on the table.
Yeah, that's something we've been noticing. I was with a couple of customers last week and listening to some calls for some owner-operators talking to the brokers about some loads. The one thing that struck me, a lot of these loads were multi-stop loads.
Yes.
And it made me wonder whether we're seeing more shippers, ship more 53-foot loads with a lot more stops because of lower demand. Are you seeing that on your end also?
Yes, I am seeing a lot of those. I started seeing it around the time that Yellow went out of business. So I think a lot of companies maybe was able to get some of that freight, but then they're trying to make it a full truckload because it's so hard to get a truckload carrier to move a less than truckload freight. But they know if you can get a full truckload carrier to move it, it'll get there a little quicker than trying to do an LTL route, right? To have it touch this leg and touch that leg and get there in 3 days, you might can get it there overnight. So I kind of see what they're trying to do is trying to balance out getting the customer the freight by a certain time, but pay kind of partial rates for it. And a lot of those loads sit for a while on the load board. I've been seeing those.
Mm.
There's lower risk of damage too, right? That was always the big thing. When it became advantageous to ship truckload, you lower the risk of damage dramatically if you can haul full truckload versus same with intermodal, right? You get it faster and less risk of getting stuck somewhere out west.
Yes.
We have a really good question that came in. We can continue the discussion. I thought we'd just pepper this question in. So on Friday, so the long and short of this was week 7 was the second worst in terms of posted refrigerated volumes in the last 10 years. And what was it like in week 8? And I meant to come back and circle around and post that. It was actually worse. Your intuition was correct there. We saw, that would be in the last 10 years, including this, so 11 years total, it would be the lowest week 8 on record. And it was actually a considerable decline week over week. Someone else had asked if that's, kind of just isolated to our volumes or total market. And we're actually seeing that market wide. I'm actually doing a broader study to see how much of it is us versus market, because I think there's going to be some kind of extra impact with us because of the brokerages you've seen go out of business. So think about, Surge, for all intents and purposes, out of business. Convoy, Yellow had a brokerage. Those volumes don't one-to-one get distributed back to the market. So I am curious. That's a question that's on my list to go investigate. But yeah, intuition is correct that last week was worse than the week prior, especially for refrigerated. We actually saw, Dean, correct me if I'm wrong here, but the load to truck ratio for dry vans last week hit 0.99.
Yeah. Just dropped under 1.
Yeah. So that means there's less loads than there are trucks nationally, which isn't good.
Yeah, the refrigerated market in particular, I had a dialogue with Mahalo yesterday about the produce volumes. They've started off at some of the lowest volumes we've seen in many years. But I think the thing with the refrigerated market, it's impacted heavily by produce season. There's still a lot of time for that market to catch up, even though we've got some fairly low volumes coming out of California right now. We've got a long way to go before that market, we get to a point like last year where we say that it was kind of a fairly mediocre produce season. We're probably 5 months away from that at the moment. Still plenty of time to catch up.
Yeah.
Saritha, driver, we were talking before the show about weather. One of the things that links to produce season is we're seeing a much earlier spring nationally. One of our colleagues was telling us they're planting onions a month earlier out in Idaho, and we're just seeing a whole different take on winter. What do you mentioned drivers reporting something very different out in Texas. Could you tell our listeners what that was?
Yes, I have a driver that has been driving for 20 years, and he went to Texas, and there's a windstorm going on, and he said he had never seen that before. And one of the receivers told him, "Oh, this is light today." And he was saying the winds was so strong, he was empty, and it was blowing him into the next lane. So,
yeah, we normally see that up in the northern latitudes, in particular up around I-80, I-90 out in the Sierra Nevadas. This is the time of the year when a lot of, especially deadheading trailers, get blown over. But I think what's consistent with that is that I think it was last weekend we saw some record airline or plane transits across the Pacific and the Atlantic, some 800 mile an hour reported plane speed. So I think there's a lot more higher level winds whipping around at the moment than we've seen normally. When a driver that's been in the business 20 years says that means something.
Yes.
And like you were talking about chains earlier, the Sierra Nevadas are about to get 9 feet of snow this weekend, which will shut down the I-80 completely.
Yes.
And the reason why it makes a difference is capacity increases and decreases as the roads become either more covered in snow or drier. And I think the thing I've seen this winter is a lot more roads have been open than closed because it's been a relatively milder winter in some of those areas.
Okay. Yeah, we and what we saw down in the southeast in the New Orleans area, that some roads were closed. Now, I've been doing it 7 years and I've never heard of them saying roads being closed. So we wasn't sure why, but there were some roads that were closed.
Yeah. So how do you handle a market like this, or is this like you always know that February's like this and this is just business as usual, or are you doing anything different this year?
Well, what we've been trying to do for the last year and a half is continue growing to get to a certain level to have a better cash flow. Since our profit margins are lower, it's taking more to. You have to do more now. We can't do less with more. We have to do more with less loads out there. So, what I'm noticing for us is that it's still tough because, again, like you just said earlier, there are not a lot of loads out there. I've seen times I could go on different people load boards, brokers directly, and they'll have loads out there. And now I go up there, they don't have loads in certain areas. So we're having to do a lot more planning. And even with February being normally a low month, we expect low volumes and it's a short month, right? We're having to work a little harder pre-planning and forecasting because we have to be careful about where we send drivers at now, especially closer toward the end of the week, because they may be stuck or they can't get out of that area and it may not be a load again until that makes sense to move the truck until a Monday or so.
Yeah, and they'll, sitting in a truck stop for a weekend is not good for drivers.
No.
Burns a lot of cash.
Yes.
Yeah. All right.
We're about on time here.
Yep.
Dean, you want to bring us to some plugs?
Yeah, a couple of quick shout outs this week. Our current Freightvine podcast with Chris Kaplis, Anne-Marie Yonkman's on. She's from Blue Yonder talking about supply chain software. Next week, we've got Ibrahim Bayan from Nuveen talking about the commercial warehouse market. He's our Atlanta-based economist. That'll be a good show to tag on to some of the discussion today. Don't forget Road Check Week, May 14 to 16. We've also just partnered with St. Christopher's Truckers Relief Fund. That's a nationwide charity that assists over-the-road semi-truck drivers and their families when a serious illness or injury occurs. If you want to find out more about that, go to truckersfund.org. And with that, Ken, back to you to wrap up the show.
All right, Sarita, thanks for joining us. Do you want to let folks know how they can get in touch with you if they want to do some business or just have a chat?
Sure. If they want to do business, they can always email us at info@sjwtrucking.com. If they want to chat with me, I am on LinkedIn under Sarita Willingham. I am on Facebook under SJW Trucking, as well as my name, Sarita Willingham, and same with Instagram. You can find me at SJW Logistics or Sarita Willingham.
Awesome. Well, we'll have to go a little less time between appearances to get you on, because this was a great conversation. We loved having you. And with that, we're going to wrap up for this week. We hope from the wind to the snow to the thunderstorms here in the Northeast, everyone stays safe this week. We'll see you back here next Tuesday at 10 a.m. Eastern. Have a great week, everyone.